If you are looking for stock market values right now, and really who isn't, please let me overpay. Do you look outside the U.S. because it's a better value? Well, welcome to Trading Nation. I'm Brian Sullivan, Max Wolff of 55 Capital, and Meb Faber of Cambria Investment Management joining us today. Meb, hey, sort of a newbie to Trading Nation. Good to see you. Welcome out there on the West Coast, so maybe a bit of a different worldview than New York. What is your thought on where the best values for our viewers' dollars are globally right now?
Sadly, it's outside the U.S. You know, the U.S., we look at long-term valuations, so we talk a lot about 10-year PE ratios. U.S. is high. I mean, it's not a bubble. It's not terrible. It's around 26. Average over time is around 17. But the good news is the rest of the world is cheap, to actually really cheap, so particularly emerging markets. And if you look at a bucket of the 10 cheapest countries, you're looking at a PE ratio on that bucket of around 10. But then again, you're buying names like Brazil and Russia, a lot of Europe, which has been really hard to do over the last few years. It's having a monster year this year, so you're starting to see some of the momentum and trend change, and we think there's a lot of room to run because these valuations of the cheap bucket are about half as the expensive bucket.
Those names, well said, but we've talked about Brazil for months now. It's had a nice run. Is it still a good value even after the acceleration it's had?
This is the beauty of some of these countries. So we wrote about Brazil in January, said it's the cheapest stock market in the world. It's no longer the cheapest, but it's still in the cheap bucket. So it's at a CAPE of around 8. Russia, one of the cheapest countries now, still sitting at a CAPE ratio of around 5. Most of the terrible news flow has receded, and that's when you can really start to see some explosive returns when things go from super terrible, like Brazil, almost a Great Depression there, to only slightly less bad. You can have many multiples of returns.
All right, slightly less bad. Max Wolff, your view on anywhere outside the U.S., maybe comment on what Meb said. Do you like Brazil, or is there something else more attractive to you?
Yeah, so for us, it's really about always having blended exposures and taking up and taking down the ratios of our exposures in different types of assets by geography, by sector, and by style, different factors for how we see the sort of global economy and the local situations shaping up. And we do that with a mind really to risk as opposed to returns. So historically, there's lots of returns maximization, certainly understand that. We sort of think we're in a new era here. The new era is really risk. The returns are, ironically, to better risk management. So what we're trying to do is make adjustments to a really global, diversified outlook expressed in terms of ETF holdings that says something about where we think things are going relatively. So I would agree, on a relative basis, the United States is by no means cheap. However, we do see a lot of what we think are quality names here. And for us, for the long term, particularly because of that risk mitigation focus, we're really interested in buying quality, and we'll pay a little more for the quality sometimes because that's a risk control metric that we like in a broadly diversified outlook. And we do sort of feel like there's really been an upward trend from July to August, from August to September, and from September to October, not only, but certainly including the election. We've seen a sort of uptick in all of our proprietary internal risk measurements. So we're even more focused on trying to de-risk. And obviously, there's some interesting stories in the EM space. We'll keep really close eye on them. Brazil is included in that group. But we're really then focused on risk, and we're really focused on broad diversification with a tilt toward always that risk mitigation, because I think what's most important for us is we want to win more when we win than we lose when we lose. And if our proprietary risk metrics are showing us a bit of an increase in risk, we're going to take that very seriously.
So basically, some headline of that is, Max, some of this is still too risky, a little too risky for you.
Yeah, we're always a little bit afraid. So I don't disagree with anything that was said. Stylistically, it makes a certain sense, but we're trying to take a really nuanced approach where everything is always on the table and everything is always managed dynamically to a proprietary outlook and to an attempt to say, how can we get you the returns you need with the least risk, not how can we get the most returns. It's a slight difference.
All right, Meb and Max, guys, it was a real pleasure looking across the world here. Thank you both very much. We appreciate it. Folks, thank you for tuning in to Trading Nation. As always, I'm Brian Sullivan. We'll see you next time.
Hey CNBC fans, thanks for checking out our YouTube channel. Here you're going to find videos packed with all of the information that you need to be smarter about your finances. You can subscribe by clicking right here and click on all the videos around me or the I right here to watch the latest from CNBC. Thanks for watching.